Great. So, welcome again to everybody to the Motivity Care Educational Series. At Motivity Care, we are here to make aging easier and simplify caregiving management. We are delighted today to have Patty Goldfarb with us. She is a certified senior advisor and principal of the Employee Benefits Advisory Group with decades of experience in both employee benefits and long-term care insurance. She really does a tremendous job of educating employers and individuals around benefits, insurance options, and making sure that they truly work for your situation. So, Patty, welcome. Thank you for being with us.
Thank you. It's a pleasure to be here.
Wonderful. Well, for some folks, we're going to start with the basics. What is long-term care insurance?
Okay. Long-term care insurance fills a crucial gap in retirement by covering expenses that are not covered by your traditional health insurance or Medicare. These are needs that develop when you have a chronic disease or a cognitive impairment, and they fall into two categories: activities of daily living, which are things such as bathing, dressing, toileting, transferring from a bed to a chair, and vice versa, or continence, or you need supervision because of a cognitive impairment, or in some states, they also include instrumental activities of daily living, which are things such as managing your finances, cooking, shopping, driving, using a phone, taking your meds, things like that. And the reason I say it's a crucial gap is because this type of care can go on for months, if not years, and it's quite expensive. Later on, I will tell you the pricing, not just in today's dollars, but also what the future costs can look like. And it's day in, day out care that you need on an ongoing basis. And it can range from home health care, adult daycare, assisted living, adult community care, or full-blown nursing home care.
Yeah. So it's really interesting because sometimes we think of it as aging and just needing more help. But sometimes it's about having a surgery, like a knee replacement or something, and having the right support around you so that you can get back to that life you want to live,
Yes.
which I think is really important. Instead of us thinking it's just end of life or just, I think there's this kind of barrier that sometimes we put up against, talking about some of these things. It can be a vehicle to keep you independent.
Yeah, as long as you need care for 90 days or more, the policy will pay.
Great. I think that's very, very important. Um,
Yes.
and I think again, this idea of, what does it cover, being very clear that it's not just in your home, it's something that can apply, if you are in a retirement community. And so it really is part of that financial care plan as
Yes.
you're planning for what your future is as a key component. I think the big question too that a lot of people, ask is when should I be asking about this? When should I be applying for a policy?
Well, there's two things to think about. Obviously, the younger you are, the less expensive it is. And the healthier you are, because we all know as you get older, you tend to develop.
Oh, Patty, your audio.
Hmm,
There you
thank
go.
you. Okay, start again. The younger you buy these policies, the less expensive they are. And secondly, the healthier you are, the younger you are. These plans are medically underwritten, which means that there are conditions that you may not qualify for or you may be rated for. And we have ways to address that. But really, I think when you're in your 40s or 50s, that's the optimal time to buy a policy.
That's really, really good to understand. I mean, we think about, well, what if I don't need this for 30 years? Like, why should I be buying it now? Or thinking about, putting it in.
I'll give you an example. I bought my policy in my 40s. I pay $192 a month. And with the inflation protection in it, it's gone from $5,000 a month to $15,000 a month over time. And
Right. So that's 5,000.
I'm still paying $192.
Right. And so you're seeing that, like, so that was $5,000 to pay for care.
Mhm.
right? And now it's 15, but literally what you're paying for it has not increased at all.
It's increased a little bit over the years, but it's still reasonable.
Right.
Whereas my husband bought a policy in his late 60s. He's paying almost what I'm paying, but he's got $5,000 a month. And it's going up at 5% each year, but he doesn't have that time span for it to grow.
Right. And these numbers may sound like a lot. We're like, wait a minute, if I'm spending this much every month, right? But what does it really mean from a financial perspective? Now I need the care. So it'd be great to hear from you, like just what we're really talking about in terms of covering those costs.
I looked at Care Scout, which is a Genworth company, to see what care costs today on a national average and what it would look like 30 years from now, just to give your viewers an idea. So in 2023, because that's the latest Care Scout numbers, a homemaker costs $68,640 a year. By 2053, that number is $166,607. A home health aide is $75,540. It's going to go up to $183,268. Adult community care, which is 24,700, is going up to 59,953.
Right.
Assisted living, the average cost across the country, and I have to say these are average. They could be higher in a lot of states. 64,200 going up to 155,830.
Wow.
Here's the really bad one, and I see less of this, which is a good thing. Nursing homes. If you want a private, semi-private room right now, the average is $104,000 a year. It's going up to 252,500. And if you want a private room, it's about 116,000. It's going to go up to 284,000.
Wow.
And you have to ask yourself, I'm saving for retirement. How much is this going to take a bite out of my retirement? And that's where long-term care comes in because it's giving you the ability to maintain the retirement that you wanted for yourself so that you can maintain your dignity and the quality of your life. And it's providing money at the most vulnerable time in your life. So it helps you protect your spouse from impoverishment, to still be able to create a legacy for the people you care about. And I mean, it doesn't have to cover all those expenses because let's face it, the policies are not cheap. But you don't think about this when you're in your 40s or 50s, but when you get to be 70 or 80 and you're on a fixed income, anything that can rock that boat, or even if you finance half of that coverage, it's a blessing
Right.
and it's an appreciated source of funds.
I think you bring up a really interesting point about as people are thinking about, right? I want to retire independently. I don't want to burden my family.
Right.
Maybe part of your goal is, I want to make sure part of my estate gets passed on to my loved ones. This is where I think it's really important to take a look at, how does long-term care insurance protect some of those goals
Mhm.
in a way that we, may not be thinking about. And I can even say, like my mother, who is full disclosure going to be 88 this year. She has a long-term care insurance policy, and she pays $8,000 a month for that. Now that sounds like a lot of money, right? You're like, oh my gosh, $8,000. Except you what you just shared.
Yeah.
That $8,000 investment that you're making means you're going to offset that hundreds of thousands of dollars in
Yes.
care costs down the road. And so I will tell you that she's, oh, I don't know if I should be paying for this. And I'm like, don't cancel that policy.
Right.
Um, because her goal is that there is money that she wants to pass on. There's charitable giving that it's really important to her as
Mhm.
part of her legacy. And so this ensures for her that her wishes are really going to be carried out. And I think, and correct me if I'm wrong here, but I think, on average, you can plan on needing some kind of support 2 to 3 years. It could be a lot longer than that, but is that accurate?
The average for men is about 2.5 years because if they're married, their spouses will take care of them. For women, it's 5+ years because women live longer and husbands usually die before their wives, and there's no support for the wife. There's no family unless the kids come in, and most people don't want their children taking care of them. It's a dignity issue as well as they don't want to burden their children. They don't want to be a burden.
Well, and
So,
I think, yeah, you bring up a very good point because if your adult children are working, one of the
or
things that
far
we
away
know,
from you.
right, or if they're not close or whatever it is, AARP data tells us that when you are making decisions for your aging loved one, you will on average spend 24 hours every week on caregiving management.
Mhm.
So this again is like just something to keep in mind. And I think if you're putting this in place, really it's to support your kids, right? You don't want your kids having their careers jeopardized because of your care. So it's
No,
a way to protect them as well.
you want your kids to supervise your care, not be hands-on with it.
Right. Which is really important. Now, I think it's also, we say long-term care insurance. You're very broad about that, but I think it's interesting that, there's not just like one size fits all kind of long-term care insurance.
No, but let's talk about how it works first.
Great.
Policies have four basic parts to them. There's the elimination period, and most people choose 90 days because Medicare says it'll cover 100 days in a skilled nursing facility. But
Mhm.
that's not really true. It covers 20 days, and if you're making progress, it'll cover additional days with a copay. I priced out what the full 100 days was last year, and it came to something like an out-of-pocket expense of almost $14,000.
Mm. That's a big chunk of change.
Yes, and that's if you get continued care, and it's only if you show progress. So you can choose shorter periods. You can choose a 30-day period if you want. Then there's how much money do you want to get on a daily or monthly basis? And how long do you want it to last? You multiply that monthly or daily amount times the benefit period, and that gives you a pool of money. So let's say you chose $300 a day for 5 years. And at the end of 5 years, you still had money left over because you didn't use it every day. You would still continue getting care until you used up your pool of money.
Hmm.
And there's riders you can add to these. So the number one rider I add is inflation because you need to have your policy grow as prices go up. The second rider I always like to add is a waiver of the elimination period for home health care.
Mm.
And then there's tons more riders depending on which type of policy you get. Anything from if you buy a policy together, you can waive the premiums for your spouse if you go on claim, to all kinds of things. And the way you go on claim is your doctor or a medical professional has to submit a plan of care to the carrier saying this is the care you need, this is how many hours you need it for. Once it's approved, most plans you will be reimbursed for your expenses. There are some plans called indemnity plans, which will just send you the entire amount each month. You
Hmm.
don't have to file claims. But let's talk about the different kinds of plans. There's traditional long-term care, which started way back in the 80s. And these are plans with lots of riders on them. You pay for the coverage until you go on claim, and then you stop paying for it. These plans, as long as you continue to pay your premiums, you have coverage. The downside is these plans were started when there was no actuarial data. So the actuaries sort of guessed at what these should cost. And they really thought originally this is going to be like term insurance. People drop these plans in a few years and we're going to make all this money. Well, people kept them and they had lifetime benefits in those days. So when people started putting claims in, and this is what you've probably read in the papers a lot about, prices went up. because there's no guarantee on the price. And then again, if you didn't need long-term care, you spent all that money and there's no return of premium unless you bought a rider for that.
Mm.
And in the early days, that wasn't available. So the industry sort of revamped itself over the last few years and developed what's called a hybrid policy. That's a combination of life insurance with a long-term care rider in it. That policy says it's still a 90-day elimination period. But what happens is when you put in a claim, you first will use up the life insurance benefit, then it will go to the long-term care rider. And even if you use up the entire long-term care rider, there's still a residual death benefit for a beneficiary.
Well, that's
May
nice.
not be a lot, but it'll be something.
Um,
And a lot of them will include the inflation rider in it, but they do not give you all the options that the traditional policy gave you.
Right.
But the rates are guaranteed, which is very nice. A
Well, it
little
helps
more
financial
expensive.
planning, right?
Yeah,
I mean, right. We want to know, right, as we're figuring out this retirement financial care plan for ourselves,
right.
how does this fit into, our budgeting process?
Yes, makes it a lot easier. And a lot of these hybrid plans you can pay up in advance. So you can pay them up in 5, 10, or 15 years and not have to worry about that at retirement anymore.
That's really interesting.
Hmm.
Yeah, so definitely worth exploring because then you don't have to worry about that when you're on
Yes.
that income. I love that. I've heard some, just about a couple, like couples, so you're buying like there's ways to combine certain things, and I had read peripherally that there's even an option where there's some coverage for overseas. I know that sounds kind of out there, but
It depends on what you're doing. A lot of plans don't like to do that. Bright House has the best overseas coverage, but Bright House, you need to pay it up within a certain number of years. So it's expensive,
okay.
but you
But
can
yeah, if there is
absolutely.
an option.
Yeah.
Yeah, that's very interesting because we have people that are, looking at potential retirement options overseas. So to understand that that's actually
Right.
something that you should explore
You
potentially,
can explore it. Yes.
if it's available.
And then finally, there's group insurance policies, which are fairly new. But what I like about them is the employer can pay for part of it. Women's rates are unisex. Most of the time, women pay more for long-term care because they live longer and use more of it, not with the group plans. And if you're the employee, it's guaranteed, so you don't have to worry about your health.
That's fantastic.
And spouses are simplified issue, which means 5 questions.
Yeah,
So
and it's a much lower cost. I mean, that's the thing about encouraging if you are working for an employer. Not everybody is going to retire with millions of dollars, right? We all know
no,
that. And so I love that this is now an option because for a very low cost and not having to worry about underwriting, is it as robust as some of these more individual plans?
no, you can only get, I think, $4,000 a month
Yeah.
with an inflation rider, so it can grow. So I look at them as good starter plans for some people who may want to add a long-term care plan on the back end. But for certain people who don't have a lot of money, this could be their retirement plan. They're portable. So if you ever leave, you can take it with you. The rates don't change, which is great. And I think that's important because something is better than nothing when you need money. You don't want to disrupt your lifestyle, your quality of life, your spouse's lifestyle. You know, that's not the way you want to go out.
Yeah. Well, and I think too, we do think of long-term care insurance, I think, for people that are wealthier, uh,
Hmm.
in general because of some of the price points. But you
But
make a very strong point here.
yes,
If you're an employer or working for an employer and you see these people that are shift workers or whatever they are, they're going to need support too. Are they going to be able to afford that $8,000 a year? Probably not. But
but
this
this is
becomes that
very
option.
expensive and you can get it down to age 18. So imagine if you bought something at 18, it's probably like pennies on the dollar.
Yeah. with the inflation rider, with the ability then to, to have that. And I love that, again, similar to anybody who's obviously work for an employer and has employee benefits, you usually get that like chunk of life insurance,
Yep.
as one of your benefits, and then you have the buy-up option. So this is the same kind of thing,
Mhm.
but I think in some ways it's even more important to talk about. Of course, life insurance is very important, and we're big fans of people thinking about that. But it is the care that you may need before somebody passes and gets that, that life insurance. So that's just why looking at and really exploring what might work best for me and my family or
Yeah.
me as an individual.
Yes.
Important.
Yes. And what should you consider when you're looking at a policy? I think there's a number of things. The cost of care today, the cost of care when you're in your 80s. The average age somebody starts using long-term care is 83 to 85. What other funds do you have that you could use? Um, what other resources do you have that could help you when you need care? What's your health like today? Will you get a policy? And what are you going to do if you can't get a policy? So I want people to think, yes, I need some help to pay for this, but if I can't get a policy, what else is out there? So I'm going to give you an interesting story. I spoke to a woman whose son owns a real estate company, and her philosophy is she doesn't want to help people stay at home because ultimately they're going to end up in a nursing home when they get sick enough. So she encourages her brokers to help people sell their homes. And she's doing this for herself. She's looking into a nursing homes or some kind of situation right now. We talked to her about a long-term care annuity, and she said, "You mean I could sell my home, buy an annuity with some of the money from that, and it would pay for my long-term care?" And I said, "Yeah, you can use an annuity. The other thing you can do if you don't want to sell your home is use a reverse mortgage. If you have over 60% equity in your home, you can usually qualify for a reverse mortgage, which means you don't have to pay that back. If your children want to inherit that home someday, they can buy life insurance to repay it back if you want. But ultimately, you don't have to repay a reverse mortgage. So it's a nice source of income. And of course, the last resort is you can consider Medicaid. But before you do that, think you should talk to MIM because you really do need a good elder law attorney to work with you. And MIM has some awesome resources for that. We have one attorney who's never had a Medicaid application turned down.
Right. And can protect. We tend to think that we can't apply for it because we have too much money, and our philosophy is have the conversation.
Yeah,
You don't know what you don't know, and so there may be ways for a very good attorney to figure out how to better protect your all the money that you've saved up, your estate, and keep that intact um, in a different way than what you might be thinking. And so there's a lot of rumors and well, they couldn't get it or whatever. We're always, please let us get you to the professional that can really give you a deep dive on the best possible options for you. I think it's interesting too. And I just want to say when we think retirement community, and we actually did a webinar about this, that I think we have this mindset about what we may have seen 20 or 30 or 40 years ago, right? Or longer, and what that might have looked at. And I would encourage you early on to look at what some of these communities look like because they can give you more freedom. Just moving into one of these communities doesn't mean you can't go out and live your life. And I'm going to give my own family example. My mom and stepdad moved into a retirement community. It's two-bedroom, two-bathroom, double car garage. She has a garden in the back. They had total autonomy and everything was taken care of. They need a appliance replaced. They get cleaning service. They take care of, the taking rid of the snow and everything else. And they literally didn't have to do anything. They don't have to worry about taxes. And they went out and traveled and did all these things. And it was pretty much like living in, their own place. But it is built that when they need care, and when my stepdad needed care, that everything was already there.
Yep.
It was built for this, and they had the long-term care insurance. So all of this played out um, in a way that really honored the life that they wanted to live.
I,
And
if you own a long-term care policy, you get a discount.
there, yes, and some, right, 100% with these communities. So I think this looking at long-term care insurance, thinking through some of these things, kind of dispelling some of the myths about some of these communities, I encourage you to go out there and look, can give you a better plan to really live independently and live that life that you want to live into your 70s and 80s. And the sooner you do some of this planning, the more freedom you really are going to have.
Yeah.
So we are almost at time. If anybody has a question, please feel free to put them in the chat. Um, but we want to thank you so much, Patty, for all your expert advice. And, from our perspective, whether you are caring for someone now or you're planning ahead for yourself or a loved one, we encourage you to think about a plan. This is what keeps you independent, and we're here to support you. We're here to make sure that your journey and whatever you need in terms of care that made your aging journey is easier and you are much more secure. Um, Patty is, I'm delighted to say, offering a free 30-minute conversation with her so that she can, give you specific answers to your questions, dive a little deeper into what these really look like, and what might be the best fit for you. So I encourage you to think about that. We're going to be sending out her contact information with the link to this recording. And again, we want to thank all of you for your time today and listening in. And we would like to invite you to our webinar next month, which will be Thursday, March 20th. And we're going to be talking about navigating solo aging strategies and kind of a different approach to that than what you might be thinking. So if you know solo agers or if you're one, please join us. Thank you. And we hope everybody has a wonderful day.